This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Good day, how you going? Phil Tarrant, host of the Smart Property Investment Show, and backed by popular demand. I've been a bit light on with this, and probably the most feedback I get is more about the portfolio that we've created inside of Smart Property Investment. And if you think back and you don't know the story, way back when Smart Property Investment was a print magazine, sort of our view was that there was so much misinformation and disinformation, two very different things. Disinformation is deliberately putting information in the market was incorrect. Misinformation is where people just assume something is fact and they just keep propagating it. Our view was that you only ever saw all that was great around property investment rather than all of the bad mistakes that people make. You never really saw them at light of day. So you'd only think, this is like a decade ago, that there was only good stories in property when there's a lot of not so good stories in property, and you only look at most property investors only own between one or two properties because typically they buy the wrong asset first and they're stuck. So we set up Smart Property Investment to actually show you warts and all what happens inside of investing in property. And initially within the magazine and the website, smartpropertyinvestment.com.au, and now on the podcast, we built a portfolio that we share with our community, warts and all. And I've got the spreadsheet in front of me right now. So there's 16 properties in the portfolio. I haven't updated this sheet, and I've spoken about it a lot. This is sort of my mapping mechanism since the rising rate environment. Now we're getting to the top end of it. I'll baseline the portfolio position over the next week or so. But we're involved, we're connected, we're current, we're getting set for looking to augment this, extrapolate out of this portfolio to capitalise on what we think is going to be good buying conditions moving forward. We're going to have a chat about that today, see where we're at. Joining me is someone who is integral to building out the Smart Property Investment portfolio, which we've built. Munzurul Khan is our accountant. He knows his portfolio well. Maybe not as large as his property portfolio, but on the scheme of things, it's probably not a small portfolio, this, Munzurul.
No, Phil, you've done so well. You've done so well over the years, and everything is a perspective, yeah.
Everything is a perspective, and property is very much unique to everyone. And
That's right.
Whether you got one property or you got 50 properties, it needs to be right for you. So building out a portfolio that's right. And one of the key things, Munzurul, building a property portfolio is getting started is key, right? Like that's probably the biggest, most important step you can do is to get going.
Yeah. And see how true that is, Phil, is that for a whole lot of reason, right, is that when we sort of start, there is almost that sort of butterfly and that sort of nervousness that do we know everything? What happens if there is a cost, and what happens if we miss something, and what's the multiplier impact of that missing things, and it's that fear of sort of an unknown, right? That's one side. And the second side is that, say, the entrepreneurs, is that very often the entrepreneurs are very, very, very successful simply because they put all their time and energy and the devotion and everything into their business, right? And the common thing which I see is that sometimes entrepreneurs is that almost because they give so much to their own business and to the client and to everyone else, is that very often they put themselves almost last on the priority, right? It's about that sort of the last sense of accountability where we sort of say that, well, it's up to me. I'll do everyone's work and then I'll sort of get my work to be done. And then when you do everyone's work, it's sort of like, well, there is no more time left. So it is hard to start, yeah.
It is hard to start, but 90% of winning is beginning. And you find a lot of property investors don't get started. We got started investing in property back in, 2012, I'm going to have to say, Munzurul.
That's right.
2012. So we've been at it for a decade, and property's been good to us. So for those of you who are familiar with this portfolio, it doesn't owe us anything, right? So we started off with, I don't know, we put sounds fun, it's only 10 years ago, put a couple $100,000 into this, which we pulled out probably sort of 3-4 years later. So, our original investment into this was pulled out. So I'd be guessing on numbers. It's we sold a property this year. We can go into that when we sort of speak sort of further at depth around this, Munzurul. But you're looking at a portfolio around just over $8 million, and it's probably got about sort of $3.5 million of equity in it. So sort of leverage at that sort of 60% type level. There's a fair bit of equity in there. And subsequent to this portfolio, obviously, myself and the other person connecting with Alex, who comes and shares his story sometimes. We've invested outside of this portfolio as well, right? But we've kept this as an example and a case study for acquiring a portfolio and then letting it sit there and letting it sit in their brew. And we've had good growth on this. I'm looking forward to spending some time over this sort of next couple of weeks to actually baseline it again from a cash flow point of view. Interest rates are going up. And we're already at a point with this portfolio, Munzurul, is that most of our loans are principal and interest, right?
Yeah.
So we've let it sort of go a little bit. We haven't been too proactive. I think the first step for us is to look at whether or not the mortgages that we have connected with this portfolio are still the most appropriate mortgages. And we're doing that right now with the folk over at Finny Mortgages, finny.com.au. So we're refinancing one of these trusts to reset it at a interest only, at a more competitive rate. And that's probably good business, right, to do that?
Absolutely. So Phil, there's just so many different points that you raised, right? So if I start with that very first comment which you made is that you started about 250 odd grand, right? Give or take, a little bit higher, a little bit lower. And then we sort of look through and we say that, well, the portfolio gained quite a bit. We've taken that equity out. So that's sort of the comment that you made, is that this portfolio is sort of almost with nil capital portfolio, so to speak, because the capital has been drawn down. Yes, over the years, there was some negative gearing, and yes, over the years, there was a bit of funding being put in as part of negative gearing, whether we've taken that out. But effectively, your capital contribution is very nominal, if not almost zero. And then when we look through with that sort of 8 mil and a bit more, and you sort of say 60% as being the equity out of it, all of those being made from zero, so to speak, right? So that's good. And that's good, right? On the other side of the spectrum, I sort of say that, okay, can we do a couple of things to sort of tidy that away a bit? Can we do a couple of things which sort of becomes a continuous sort of progress and sort of improvements? So yes, there is an argument of saying P&I is that whether we pay them off after a certain period of time, but it's sort of the cash flow, right? And particularly while the interest rate is sort of so high, the benefit in my mind of interest only is that most of the loan, if not pretty much all of the loan, you still have an additional repayment option anyway, right? As opposed to the P&I that is sort of being obligated as part of the P&I. Your serviceability side of it as well, arguably being interest only, is that also has a positive impact to it as well, right?
Yeah.
So definitely.
Yeah, and there are so many moving parts to this, and it's really it's an opportunity for us just to baseline where we're at with it all. We're going to take a quick break. When we come back, we'll chat a little bit more in depth of some of these assets back in a moment. Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Munzurul Khan, KHI Partners, our accountant. We're chatting through the Smart Property Investment property portfolio. Good little portfolio. It has assets, New South Wales, Victoria, and Queensland. It's all residential property, and one of the big discussion points now is what's next for this portfolio, considering the current market and, extrapolating out into commercial property is a potential for this, isn't it?
Yeah, look, it gives you a right bit of the balance, right? And the reason I say right bit of the balance is that many of the comments are probably generalizing to some extent, but residential property, you sort of always sort of see that arguably the return are relatively lower. Whether we argue the compensation of that is coming in with the growth and sort of the compounding growth and at the high level of the growth. Commercial property on the other side is that one sort of says that, well, you've got the return, right? And very often is the tenant. If the tenant's sort of being vetted in the right way, you've got a 3 years lease, you've got a 5 years lease, and you've got that sort of continuing level of the rent. And very often the tenant sort of pays all the bills and everything, right? Even with the land tax, that the tenant can pay the land tax with the right level of negotiation. So you've got that absolute net level of return, and you also have the growth as well with the commercial property. Is a mix of it is the right balance? I see a lot of merit, absolutely.
Yeah, there is. And these are all options available to us, but the most important thing is getting the finance sorted out, getting an understanding of the cash position. And this portfolio has always been negatively geared, Munzurul, which we chat about. And one of the reasons why is all these properties are held inside of trusts. You don't get any land tax breaks inside of trusts, particularly in New South Wales. Is a bit different in Queensland. The cost to hold this portfolio is a little bit higher as a result of some of those structural decisions that we made, which were appropriate. But, if we were to have refinanced this back to interest only before these interest rate rises, it would have been positively geared.
It would be positively geared, right? It would be positive geared because I've got some of the numbers that I'm sort of looking through. And if you go back all the way from the inception with that sort of the 16 properties that you have, 17 Berkeley Vale being sold. So you've got those 16 properties. Is that, yes, it cost us a little bit. how much has it cost based on the numbers, how we do. It's about 35 grand or so on average over the years.
Yeah.
And that's after taking some of the tax benefits, right? Then you sort of say, well, if it costs 35 grand per year and you've got an $8 million portfolio, as a number basis, that's not bad.
It's not bad. And you break it down, it's a few $1,000s per property, right?
Exactly.
It's negatively geared and
Exactly.
it's from a cash flow point of view, but there's also benefits for being negatively geared, right? Because it gives you options in the future should you start to liquidate assets, correct?
That's right. See, trust, each structure has its positive and negative, right? The trust, as he said, that in New South Wales, there's no land tax threshold. In Queensland, you get about 350 odd grand. Does it really go a long way? Victoria, you get a surcharge rather than any threshold as such. There's about 25 grand threshold. After that, you get a surcharge. But a benefit of the trust is that one is that you've got the asset protection, and number two is that you've got that flexibility of the distribution of the profit. And the losses that you make on the trust, those are the losses it gets carried forward. So while we do not utilize that against your individual as such, on a year in, year out, we don't lose the losses. So we're accumulating all of those losses. So if we do sell or dispose something, is that we utilize all of those loss and the tax only comes in after those loss being utilized in the right way of distributing the profit.
So you get sort of the double effect of negative gearing and carrying forward losses subsequent to the negative gearing that you can realise at a point of sale.
That's right.
Yeah.
That's absolutely right. Negative gearing is there. It's just a bit of a timing, right? So on an individual basis is that you get the negative gearing every year as such, whereas the trust, you get that negative gearing, so to speak, is the real tax benefit is when you sell it. And or if your portfolio becomes quite rather positive cash flow. So your commercial property, as an example, is that if we look back, the commercial property is about positive cash flow, right? And if that's sort of a commercial property being put into one of those trusts and you've got all of those losses, those positive cash flow, there would not be any tax unless and until we utilize all of those losses. So there's benefit to it.
There is benefit to it. And these are all the stuff that a good accountant can help you out with. But the point would be, and I would admit that I've been a bit sort of sloppy on this, is that I'm not aware of, and this is a lot of people may be like this. I'm sure Munzurul isn't, because he's a lot more diligent than I am. But are we charging market rate for our rents right now?
Yes.
And I couldn't hand on heart say that we are.
Oh, mate, the rents have increased so incredible, right? So incredible the rent have increased is that some of the rents that you sort of look through where it is and where it is that it can increase, it almost takes a sense of bravery to even suggest that to the property manager that you increase that by 30% or 35%, but that's what the rent is at the moment. And I think it will continue increasing next year.
Well, it's a good point because the scarcity of, vacancy rates at record low settings. We're now going through this pathway, and last time we got together, we spoke about the great migrant story that is Australia. Borders are opened up, and post-COVID, Australia is even more attractive. And I think we've got quite a liberal approach to how we can support skilled migration into Australia. And typically, that cycle is migrants arrive and they rent for a few years. They get themselves established and continue with their work. They start sort of putting their roots down, and then they buy property, right? But there's a period of time where rental property is key.
Absolutely. And see, if anything, because we didn't have any migrants for about 2 years or so in between the COVID, we're almost doing a bit of a catch-up. And that catch-up is not a one-year catch-up. It's a multiple year of sort of a catch-up. So there would be a good period of time that the migrants would be just a bit more than what our traditional sort of the migrants. That's one side. On the other side is that if you look into the construction side of it, the construction demand has reduced. And the reason why it has reduced is that, of course, the construction price is quite a bit high, and there is that sense of uncertainty because of the lack of the materials and the labor for that matter, right? So you've got the construction being reduced and the new dwelling being reduced, but you've got more people coming in. So what are more people doing? They're fighting for a limited number of resources as such, and that naturally means that the rent will increase. And you know what the beauty of it is that if we look back into the cycle, right? If we look back into the last, say, 20 years, 30 years, 40 years cycle, it's actually not much different than what it went through in the previous cycle. When the interest rate does increase, is that at that point of time, people can buy a little bit less, and they do buy a little bit less. People can construct a bit less. They construct a little bit less, but the population growth just continues as it is. This time it's being amplified with that COVID and all the rest of the matters, but population growth sort of increases. And all that does is that puts that pressure on the rent. The rent increases until one day the investors sort of look back and say, hang on, guys, the rental return seems to be pretty good. And or that if the RBA comes in and says that, well, we're right at the peak of the interest rate and next move is probably down, That's where that sort of renewed level of the enthusiasm comes in. And then you re-look through and say that the rental returns are good. And you almost have that tick of that mindset and how quickly that it happens and the prices expands again.
Yeah, and this comes down to moving forward asset selection for investors. Have a chat about that, Munzurul. Just go to another break. Stay with us. Back in a moment.
Want to slash thousands off your home loan repayments? Whether you're an investor or homeowner, we know how important it is to find the lender that suits your unique situation and with the best rate. If you've not compared your home or investment loan in the last 12 months, you may be able to cut your repayments today with a different lender. That could mean more money in your bank account and less stress when it comes to paying your loan. Find out why more borrowers are turning to Finny to refinance their home loans. Call us now on 1300 002 023 and find out what you could save, or visit our website finny.com.au to book an appointment.
Welcome back. Phil Tarrant from Smart Property Investment with Munzurul Khan from KHI Partners. Now, Munzurul, before the break, you were chatting about essentially serviceability levels are down because interest rates have gone up. That means people aren't able to maybe buy the type of assets they wanted to buy beforehand. So it's really reset the price point for some people. And part of the product of that is prices have softened a little bit. Like, this is the supply and demand cycle. Where would you, as a property investor right now, because, not everyone could invest in blue chip sort of $1 million properties as property investors, that the baseline is still people are investing in more affordable locations, mum and dad investors. Which markets do you like at the moment? Where do you think we should be considering? What's next for the smart property investment portfolio? Do you think? Look, residential, not the commercial stuff that we spoke about.
Sure. I mean, I suppose there's two answers to it, right? And none of those are advised. This is just sort of the personal experience. And there is two sides of it. One is a macro answer and one sort of an individual answer. And I think I'm a lot more keen on the individual answer rather than the macro answer, right? But the macro answer is that you always sort of look through and you sort of say that, well, in longer period of time, which other cities have done the best? It's Sydney, it's Brisbane, it's Melbourne, right? Or it's Sydney, Melbourne, Brisbane on that particular order. Yeah, okay, Perth has done a bit and it has done a bit over a period of time. You know what? Tasmania did very well for a period of time. Adelaide is still pretty strong. So all of those has some bearing, but in average, one probably still sort of argue that whether it is Sydney and Melbourne and Brisbane. And that's where sort of I'm sort of looking into from my end, saying that that's a longer term as such, right? But that's general. Then we go back to an individual circumstances and we say, well, yes, okay, so theory is good, but we can almost sort of afford to buy what we can afford to buy. So if we can't afford to buy in Sydney, where we sort of say, yes, Sydney price may have dropped by 10, 12%, but when you look through from the historical sort of the high level of the average, even after that drop, it's still damn expensive, right? And then you compare that with some of the other estates and you sort of say, wow, the rental return seems to be a lot higher. So depending on your individual needs and your individual circumstances, if we can't, I say that very often, right, that our budget gets determined by what we can borrow, right? So if the budget sort of gives us a budget of saying 600 or 1,000, then we get limited with 600. If the budget gives us 1.5, then we sort of open quite a bit. So I think the individual circumstances needs to be looked into in terms of your current cash flow, in terms of your existing and future cash flow, and potentially with some level of exit plan, what age bracket that you are in, right? So the advice on individual basis will be very different to someone who's in mid-30s to, let's say, someone who's sort of late 50s. Someone who's sort of late 50s may sort of say that, well, the cash flow is more important, as opposed to someone who's sort of mid-30s say that, well, I've got a lot more income potential, so I would go for a bit more growth. I'll actively take a little bit more hit in terms of the cash flow because I know I can manage it, right? It could be husband and wife. There could be one income potentially moving into two income. That has a bearing. Or it could be the other way around, two income for a period of time that it goes into one income, right? So your individual circumstances, my strongest recommendation is to sit down with your property planner, with your buyer's agents, with your mortgage broker, with your accountant and say, let's have a look through the SMART goals. Let's have a look through of exactly where we are and what is right to me on the basis of, I suppose, what I can afford from bank's perspective.
Yeah, that's good counsel there. And it is individual to everyone. But again, it comes down to mindset and having a proactive approach to investing in property, and that's where you'll uncover those. Well, you uncover the strategy that's right for you, and all those also those assets. What do you think about sort of rural, regional Australia investing at the moment, Munzurul?
Look, I mean, I've seen a lot of investors that sort of done it over the years, right? And very often it sort of comes in with sort of cash flow. There was a period of time is that all the sort of mining regional is that why would we not buy it? Because they're sort of sitting about 10, 12, 14% return. I remember many years ago, I bought 4 properties in a place called Mount Isa.
Okay.
Right, many years ago, right? Because I genuinely needed cash flow, right? And I sort of said to myself, Mount Isa, mining town, absolutely middle of nowhere, right? You've got no other industry. They claim that, well, there is a bit of tourism. I question it, right? Whether it's a tourism or whether it's just purely mining as such. But I bought it. And for some reason, within a year or so, all of those prices doubled. Now, this Mount Isa, which has seen no growth for years and years and years as such, is that they doubled because a lot of investors have started buying it because of 11, 12, 14% return. And I said, you know what, Mount Isa, I'll sell it. In my circumstances, I moved out of it. Someone like me that I never sell. That was an exception that I sold it because I didn't see the longer term prospect, even though I was fortunate for that bit of a gain.
So you sold at the right time though?
I was fortunate at selling the right time because I bought it at 11, 12% as an example. And those Mount Isa properties, they sort of went down all the way to about 4.5%, 5%. And at that stage, this was back in 2012, 13, 14, right? And at that stage, I could buy 4.5%, 5% in Melbourne instead of 25, 30 kilometers away from Melbourne. And I said, Mount Isa, Melbourne, I'd much rather have in Melbourne for a longer period of time with the growth if the return is same. So I don't have anything exactly, I suppose, opposed to sort of your regional, as long as you are very carefully thought through and sort of find the reason why you're buying it, as opposed to just looking at that immediate level of the result.
Well, Munzurul, we've just scraped the surface with the Smart Property Investment Portfolio. Thanks for coming and having a yarn. We'll be ready to sort of dig down into this and interrogate the numbers early in the new year once I've been able to baseline it again. It takes time, energy and effort, right? Like, you know, mortgage statements and you've got to speak to every single property manager and all that sort of stuff, which is good fun. But stay tuned, everyone. Back with a lot more information and strategies for what we're going to be doing with Smart Property Investment Portfolio moving forward. That's Munzurul Khan from KHI Partners. Thanks for coming in today, mate. It's always good to see you.
Thank you.
Thanks for your support. Remember to check out smartpropertyinvestment.com.au. Social media, Smart Property HQ is where you'll find us. Please keep those reviews coming. The team get a real kick out of it. Most of you on probably the podcast player on your Apple iPhone or anywhere else, please keep them coming. We do appreciate it. It's nice to know what we're doing is resonating. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
HR Leader is your source of news, insights, and more for HR, leaders, and people managers. Subscribe today at hrleader.com.au.